Hi, I'm Richard Vague with Tychos. India recently announced a 7.6% real annual growth rate in its GDP, which puts it at the highest level of all the world's major countries. That's even with an inflation rate which has been in the range of 4 to 8%, surprisingly moderate for a fast-growing, less developed country with a young population, especially in a world seeing higher overall inflation. India is worth taking note of since it is now the fifth largest economy in the world on a currency exchange basis and the third largest on a purchasing power basis. At that growth rate, India has for the moment displaced China as the fastest grower among the world's big countries. And even though it is still far behind the other big countries in terms of per capita income and net worth, it has favorable fundamentals as regards the key factor we watch most closely, private sector debt. Its private sector debt ratio is 100% as compared to an average of 167% among the members of the Big Seven. Now we would note that we have seen a very recent rise in this private debt level, and we expect to report more on it in the very near future. And its current government debt ratio is 82% as compared to an average of 124% among the other members of the Big Seven. Having relatively low debt levels in comparison to these countries is an economic advantage, leaving ample room for increased debt growth to power GDP growth. The main area for improved performance for India is in its trade and current account surplus, which is a disappointing negative 1.7%, a surprising position considering its wage advantage, and well below China. India also has the difficulty of its increasingly strident internal politics, resulting in part from its continuing conflict between its political and religious groups. Yet, even with those issues, India could readily continue to stand at the top of the list of the world's fastest growers for some time. That's it for this week. Thanks.